Let us discuss pricing methods. In simple words, we can say that price is the value of product expressed in monetary terms. It is the value of product that is expressed in monetary terms. This we know very well after barter system. When the medium of currency came into existence, we are dealing the selling and purchases through money. So it is value of product expressed in monetary terms. We can say that it is a weapon for a company or for a producer to achieve his target. If he adopts unsuitable pricing system, he may not going to achieve his target of profit maximization, wealth maximization, increase of market share, whatever it may be. So in order to achieve all those targets, price and pricing is the main weapon, because all other three pieces of marketing, so not pieces, this product, price, I repeat in every class in order to remember you people. Promotion. Except price. Upon all these three P's of marketing, he is going to incur somewhat cost. But this is the only incoming point to the producer. So it is a weapon. If it is a weapon, he should use it properly. Otherwise, the success of introducing a product may not be successful. Briefly, in today's class, let us discuss around 3 to 4 methods of pricing. Usually, while deciding the price of a product, a company takes into consideration about few factors, just like demand, cost of the product, and competitor's price. So these are the basic factors in taking a decision about this pricing and price. In this process, there are few methods in marketing management or principles of marketing. Those are cost plus pricing, next one is break-even pricing, marginal cost pricing, going rate pricing, customary pricing. Basically, these are the important methods of pricing. So let us discuss one by one in detail. Before that, Each and every pricing method is having its own merits and demerits. And we cannot say that a particular method is the best method because it depends upon the firm, not only the firm, whatever the product they are producing, in which market they are releasing, to whom, means customer, which category of customer. So based upon all those factors, producer may use any of the method. So depends upon circumstances. He is going to adopt a particular method based upon its merits and demerits. The first one we all know very well, cost plus pricing. In order to fix a price in cost plus pricing method, the producer first of all is going to calculate or determine the cost of producing a particular good. Based upon that, he is going to add somewhat profit. Then he is going to fix the price. So, for example, if a product for the purpose of producing, producer is incurring 100 rupees, he initially targeted it, whatever the cost is there, on cost, he's going to add, let us take an example of 20 rupees as a profit. Then the price is going to be 120. So this is cost, profit, price. So cost plus pricing. What is that plus? Profit. Usually, most of the producers may follow this type of pricing system because whatever they are incurring towards cost, then they are charging somewhat profit. Means at any cost, they will incur into losses, mostly, if demand is adequate. For example, if a producer is introducing a new product into the market, sometimes he will not be having a complete idea about the cost of a product because of lacking of experience. Under that situation, this may fail to fix a price or succeed in the introduction of the new product and getting back whatever they incurred in the form of inputs. So let us discuss the merits and demerits and also reasons to follow this method. First one is the producer or seller or sellers are more certain about cost because they will be having that information, whatever the expenditure they are spending on inputs, they are having that idea. So that's why certainty about the cost. So it is easy to add on that profit and fix the price. So because sellers are more certain about cost, at that situation, this pricing method is suitable. Because the seller is not certain about the demand, and competitor strategies. So all those. So that's why if this method is suitable and it adaptable because it is having few merits. Next one is when all the industries, when all the firms in an industry, for example, if you take an industry of steel, let us take an example of 3 companies are existing, or we can say around 10 companies are existing. If they adopt the cost plus pricing system, more or less each and every company is going to incur the same type of cost in order to produce the similar type of products. So there is no price variation between all these companies, more or less. If they are maintaining the same price for the similar product, what happens? No price wars. If any price war is existing, definitely the consumer may think for the specialities in the product, may look for the specialities in the product. Then based upon the whatever the new features or whatever he is expecting, based upon that he may switch over to X or Y or Z or any other. But mostly they will be incurring same type of cost on inputs, then they will be adding profit, fixing of price. So when all the firms in the industry is using this cost price method, cost plus pricing method, overall the industry prices will be same. At the time, customer will be benefited. When customer is benefiting means, when customer is benefited, definitely he will be coming back to purchase the product again and again. So he will become loyal consumer. Then day by day, increasing of sales to a particular company. So when all the firms in the industry are following this cost plus pricing method, complete industry pricing for the same product will be same. So no price wars are going to exist. And also it is useful or beneficial for both buyer as well as seller, because seller is getting the input cost back along with the profit. The customer is also getting the worthy product because they are charging based upon the cost incurred and somewhat amount of profit. So they are not exploiting from the buyer. When seller is not exploiting the buyer means buyer will be benefited. So here mutual benefit in cost plus pricing. So if they want to benefit mutually, better to go for this cost plus pricing. If a monopoly company is there, definitely they will try to capture the advantage because no other substitute product is available in the market. So they can rule the market, they can fix the price irrespective of the consumer status, because only one seller is available in the market, many buyers are there. So all the buyers, there is no option for the consumer to go with the substitute products or competitors' product. So at that time, that may not be mutually beneficial situation. So here, if it is a perfect competition, mostly they will look for mutual benefit. If it is that situation, this is useful. Next, let us discuss merits and demerits. It is very simple to calculate. So they can sum up the input prices. They can add on each and every element what they are incurring towards the production of the cars. Let us say on material 10 rupees, on labor 5 rupees, other expenses 2 rupees. Keep on, they are going to add on. So he will get the price that may be 15 or more. So based upon the inputs price, just adding up. Along with that, some fixed percentage of profit. So it is simple to calculate. No calculations, other mathematical calculations are required, only addition. So very simple to calculate, simple to understand. As I told, here no price wars means eliminating of price competition. Please mute yourself. If price wars are existing, we can say that consumer exploitation, scope for consumer exploitation. If price wars are not there, definitely no price competition. Fair system for the purpose of marketers, producers, and consumers. So mutual benefit oriented. So no price wars. As I told, they will go for fixing the price based on demand, cost of the product, competitor's price. Any of these are all the factors. When a producer is not certain about the demand, better to go for fixing the price according to the cost of the product. So when other factors are not giving, means the other factors details are not available, or we can say that we are not in a situation to forecast the demand and competitors' price at the time, it is useful in determining the cost. It leads to competitive harmony. Healthy competition. Mainly, it is suitable for service sector, public utilities and service sector. Whatever they are incurring cost, they are going to add somewhat profit and fix the price. Mostly, these public utilities and service sector companies will adopt such type of pricing system. Coming to the point of demerits. As I told, when demand forecasting, they are not in a position to forecast. They're adopting such method. So definitely, completely they are ignoring the demand factor, which is the most influencing factor in fixing the price. As we know, demand and supply determines the price under most situations. So if demand curve is like this, supply curve is like this, the intersecting point will be the price. So this concept, this method is ignoring such concept. Under most situations, this is a suitable method, but it is ignoring that demand factor. Moreover, it is not suitable for large firms. So not suitable for large firms. And also, at the time of introducing a new product or initial stage, this cost plus pricing may not be suitable because they are lacking in experience in estimating the cost. So it is not suitable under the situation of initial stage. And also introducing the new products. We can say that unrealistic also. Because it is ignoring the factor of demand. So it is one way. From the production point of view, producers are fixing that price. Means it may be unrealistic under certain situations. So these are the merits and demerits of this cost plus pricing method. This is cost plus pricing method. Next one, break-even pricing method. Principles of marketing, break-even pricing. According to Philip Kotler, who is father of marketing, break-even price, this is nothing but BEP, means setting price. Please note down if possible, setting price to break even cost of making and marketing. Cost of making and marketing. Usually, producers are interested on a return on investment. For example, if you are investing 1 lakh rupees on a certain project, definitely we expect somewhat rate of return. Rate of return or rate of interest, whatever it may be, rate of return. For example, let us assume 10%. 10,000 we are expecting as return on investment, which is 1 lakh rupees. So, in order to achieve this profit, what should be the price? So, they are considering the return on investment. It is nothing but setting price to break even cost of making and marketing. In making, we are going to consider all the inputs from the stage of production to selling and marketing. So it's a price to break even, cost of making and marketing. Mainly, they will be focused on return on investment. Usually, if a company is having more than one product and a product is purchased infrequently and another product is coming Saturday and Sunday will be the last sessions for your principles of marketing classes. We are running since I think last week. With the next class, you will be finishing the portion. You can go through the links for the previous classes, whatever the portion we covered. So if one product they are selling infrequently and another one is frequently. For example, X and Y products are there. These are occasional purchasing products. These are regular products. So what happens? They will be earning the income or profits on Y, on selling Y product, but not at all that much amount on X product. So in order to reach their target of return on investment, they will adopt break-even pricing because it is cost of making and marketing. So at any cost, they are going to get back their input costs. So mainly, based on frequency of selling, if one is frequent, another one is infrequent, it is better to adopt break-even pricing method. Please tell me, you can unmute yourself, fine. Please tell me. Someone raised hand. Anything is there? Okay, sorry for the interruption. In order to set this break-even pricing, in order to get back the cost of making and marketing, we should know 3 to 4 terms in this break-even method, break-even pricing method. Those are, first one is total cost. Fixed cost. Variable cost. And sales volume. Total cost is nothing but it is sum of total fixed cost and total variable cost. Fixed cost is known as overhead cost. Do not vary with the production. Means irrespective of the volume of production, this fixed cost is going to remain constant. Such type of costs are called as fixed costs. But whereas these variable costs are going to be varied according to the level of output. That's why we are calling variable cost, variable with level of output. If we increase the level of output, variable cost is going to increase. If we decrease the volume of output, variable costs are in lower in terms. But whereas irrespective of the production, fixed costs remain constant. Next, sales volume. Mainly, the volume of sales depends upon various factors. Level of production, demand, and many other marketing aspects. It is nothing but sales quantity multiplied by the price per unit. Let us discuss merits and demerits of this break-even pricing method. It is very much useful in decision making. Obviously, this pricing is also requires the process of decision making. So the producer is going to analyze the effects of different prices and profits. Then coming to the point of fixing a particular price to a certain product. Here, what is happening? Based on whatever the return on investment he is expecting, that is going to be included in cost of making and marketing the product, then fixing the price. So it is very much useful in decision making. But whereas cost plus pricing, not required of decision making. Whatever they are incurring on cost, they are adding somewhat profit to that. That's it. But here, decision making is required, because we are classifying the cost into fixed cost and variable cost. This is going to remain constant. This is going to vary with the level of output. For the purpose of profit planning, profit depends upon sales volume. Sales volume depends upon this fixed and variable. They are in the controlling situation. Profit planning will become easier. If you are certain about profit planning, that will be useful in pricing decision, product planning also. Means whether to increase their product line, their product depth, their product width. You can take the decision according to this pricing method. So these are the merits. The cost price pricing is suitable for long run. Just like that, it is also suitable in long run means in short run, it may not be useful. This is the drawback. Because selling and distribution costs in long run, it is having the impact to increase the cost like selling and distribution. And it is not worthwhile in the long run also. Usually, when they are introducing a new product, initially, they need to incur much upon selling and distribution. But later on, it may not require that much. That may be more or less. But what we are saying here, the cost of making and marketing and also categorizing fixed and variable. But it is not going to remain same throughout the product life cycle. Then it is a question mark. It is suitable in the long run, but it may not be advisable in short run. And many other factors like technological changes and many implicit factors we are not considering, only focusing on fixed and variable. So other factors we are ignoring in this method. Third one is marginal cost pricing method. This question is an important question from your examination point of view. They may ask, what is pricing? What are the different pricing methods and advantages of pricing? Factors to be considered while fixing the price of a particular product. Marginal cost is nothing but additional cost incurred in order to, additional cost with the increase in the level of production. For example, if your company is producing 1,000 units, they are incurring 1,000 rupees. Say for example, if they are producing, means they have increased 1 unit of production, sometimes they may incur the cost of much more than number of units, or we can say that not in the proportion to this 1:1. Sometimes it may happen. So additional cost going to incur with the increase in the level of output. Mainly in this method, fixed costs are ignored. So this is additional amount of cost with the increase in the level of production. This is the main feature in marginal costing. We may know that sales can be in real market, sometimes in a boom situation, sometimes in depression situation. The same product only for few months, sales are in high range, but for few months. It may be decreasing or boom and depression. So according to this method, it guides the fixing minimum price during depression that should be equal to marginal cost, because fixed costs are undoubtedly firm need to pay at any cost, irrespective of the level of output. So what they are thinking, at least they should get back these variable costs. Nothing but in the depression situation, sales are very less. So that's why at least they would try to get back these variable costs. So whatever the price they are charging is based upon the summation of variable factors, not upon fixed costs, because these are the costs at any cost they are going to incur. Means the level of output is not impacted. It is very much useful in short run. The above two methods are suitable for long run. This is suitable for short run, because we may see the situation of boom and depression and also many other situations in between these two, boom and depression. If they at least get back that marginal cost, there is no loss situation for the producer. We can say that it is a win-win situation for consumer as well as for the producer. So this is suitable in the long run. It is more accurate system because it reflects future as a different from present cost levels and cost relationships. Definitely, future may be uncertain. It is very much useful in the product life cycle. We all know very well, in the competitive market conditions, most of the products are reaching their final stage in product life cycle. So at the time, it is inevitable to go for introducing a new product. That is not that easy situation for a company. So at the time, if they adopt this marginal cost pricing, they will not enter into losses. Fixed cost, that is anyway they have to incur. That's why they're not focusing, even though the product reached the last stage of product life cycle. Coming to the point of demerits, if it is useful in the short run, means it may not be beneficial in the long run. If any method is suitable in short run as well as the long run, then we can say that it is a fair method of pricing. Means always switching over of their method to adopt in pricing. It is useful in short run only. And other costs, technological changes, sometimes semi-variable costs are going to be incurred. Here they are taking into consideration only fixed and variable. In order to consider a method as a good method, definitely They should accept, they should consider all the factors of cost, that may be anything, material, labor, visible, non-visible, explicit or implicit. Here, they are ignoring such type of implicit costs and many other financial accounting aspects. Coming to the fourth method, that is going price system. Going rate price system. This is so simple, nothing but adopting a price which is running, which are prevailing in the market. So simply, blindly, they are adopting the prevailing price in the market. So it is nothing but, it is a system of setting prices in relation to the prices of competitors. Competitor, whatever the price is charged by the competitor, blindly we are going to follow the competitor's price. It is so simple because no need of calculation, no need of research, no need of struggling all the input gathering information, nothing. Only we are going to observe the market and competitor and taking the same price to our product also. But it may not be suitable in all the conditions, because if the other competitor is not a perfect price determiner, then what happens? We are blindly following that strategy. If the other person is not able to fix the price accurately, then copying of others' price is also a blunder mistake. Means if a competitor who is in a position to calculate accurately, to determine the cost accurately, then only this going rate pricing system is going to be a good pricing method. Otherwise, it is a waste of attributing according to going rate pricing method. We can say that it is a popular method and also suitable in the long run. When we are allowing the competitor's price in order to fix our product price, definitely we will win the contract in future, because all the people are bidding the same price, more or less. If there is drastic difference in the contract price, definitely the person whoever quoted the highest price will be winning the bid. But here, they're adopting going rate. Going rate means the rate adopted by the competitor. This method is also suffering few demerits. That is difficult to measure accurately, because we are blindly following the competitor's price. If they are not measuring or attributing accurately, then the problem is happening with us also, our product sales also, getting revenue and all the aspects. This is suitable mostly for the large firms. So it might not be suitable for the small firms, because a large firm on the whole, by selling multi-products, the company can sustain because it is selling many number of products. If the competitor is not adopting a good estimated price, even that situation also it is going to be overcome, because it is having another products. It is going to get the profits through other products also. Summation all together, that company is going to be in a profitable situation. For example, if I am selling a sole product, single product, then wisely I need to take the decision regarding the product, because the only source of getting profit is the only product what I am selling. Otherwise, if I am selling multiple products, definitely if 3 products are giving profit, if one product is giving loss, at that time also I can handle the situation, I can manage the situation, I can overcome the losses. So this is suitable for a large scale companies, and undoubtedly unsuitable for the small firms. Last one is customary pricing. The name itself explains us. The producer will adapt the price which is acceptable by the consumers. How he will come to know about what consumer is expecting? Means general expectation. If I am expecting few features in my mind, the product should have the price of 100 rupees, I think so. Like that, I may have an opinion. If I am purchasing a product for 10,000 rupees, according to that price, we will be having some expectations. So based on those expectations by the consumer, they will fix the price, that is going rate price, not going rate, customary price, sorry, customary price. According to this method, consumer expects a particular price to be charged or fixed a certain product or commodity to suit their conditions. If I am having a mobile, I would like to sell that product, means I should explain the features about the product. Based upon that, the other party will be having an idea in his mind how much I can spend on this product. So based upon the qualities, requirements of the product, fixing the price. The product itself cannot think. That's why we are thinking by taking in view of the product features. So customer expects a particular price to be charged. Based upon that, fixing the price. We can say that customary pricing method. Only a few firms will follow such situation, because it is highly impossible to know about the customer expectations full-fledgedly. So it is not a suitable method for all the firms in all the conditions. In addition to that, many other pricing methods are also prevailing in the market. Those are administered pricing, dual pricing, differentiated pricing, geographical pricing, psychological pricing, and tender pricing. But mostly these 5 methods are important in pricing decisions. So this is all about pricing and pricing methods of pricing. If you are having any doubts, you can reveal so that I can clarify. Otherwise, I will leave the session. We'll meet in the next class. Are you having any doubts? pertaining to this class, ma'am?
When is the next class, ma'am?
Saturday and Sunday will be the last classes.
Okay, ma'am. Thank you.
Okay, shall I leave?
Yes, ma'am. Thank you.